Welcome to the On the Rise podcast, where we talk about time freedom, passive investing through real estate, finance, and mindset. Let's dive in. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice. I am not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. All right, welcome back On the Rise podcast listeners. Thank you again for jumping into yet another episode of the On the Rise podcast. I'm your host, Jeremy Dyer. I've got another amazing guest with me today. I've got Tony Figliola. Tony, welcome to the show.
Appreciate it. Thanks for having me.
Yeah, absolutely. So a little bit of background on Tony, and then we'll dive into it. So Tony's the founder of Passive Investment Pros, where he helps engineers and technical professionals diversify beyond the stock market by investing in private multifamily real estate opportunities that he personally invests into and that he vets. With that said, Tony, would love for you to let our audience know a little bit more about yourself, your background, what you're focused on today, etc.
Yeah. So I am a mechanical engineer by trade. Got a 4-year degree, got my bachelor's in mechanical engineering, and started right out of school doing facilities design, stuff like that. Real quickly after I graduated, I kind of realized that, there's a little disconnect with what I wanted to do, what I was doing, and I kind of wanted to, supplement some income and, really just kind of figure out a better way to not work till I'm dead kind of thing. No one really wants to work till they're 65 beyond. But I feel like when you find something you like a little bit more, it doesn't really feel like that. So yeah, I naturally started, listening to podcasts, reading books about, alternative investments, stumbled on real estate, started a lot of education into the single family space, doing bigger pockets type education with, the Burr method, stuff like that. And, shortly after that, I kind of stumbled upon syndications, had no idea what that was or what that meant, and started really just, continuing to educate on that. And it just, after a while clicked and it made a lot more sense from a scalability perspective. And, having more units under one roof, it just made sense to me, really. Just I'll leave it at that. And so I started kind of down an operations track where I was trying to do everything myself and sourcing underwriting deals, talking to investors, working on asset management strategies, trying to basically acquire something and operate it and do the whole shebang without any partners. And after a while doing that, it didn't really pan out for me. It was difficult to get investors to buy onto that kind of model with no track record and basically having one guy doing everything. It wasn't exactly practical. And so at a certain point, I kind of made a pivot into more of the capital side of things. I had done all this educating on analysis and sourcing and the asset management pieces. I knew what needed to happen. And so I kind of translated that into a rigorous vetting process that I could use for investing in my own deals passively. And, as I started to realize that with more capital comes better terms and that sort of thing, I, started kind of raising from other people as well, figured out that I could get us all better terms by, aggregating that capital.
Yeah, it makes total sense. And, you have an impressive background and really a unique, I would say, gift in doing diligence on operators and deals, which is, I would say above average from what I've seen, in the marketplace. But before we dive into that, I'd love to know a little bit more about, kind of your own personal avatar. I know you've got a background in engineering. You're kind of drawn to, technical type professionals. Why do you think that group of individuals in particular is so drawn to passive, real estate investing? And, maybe what mind shift does somebody, that is an engineer or they're a technical professional, need to get to before they realize that, maybe passive real estate investing, is a strategy that they ought to consider, deploying capital into, as opposed to just the traditional rinse and repeat, Wall Street investments or active real estate ownership.
Yeah, so to start, my avatar is mainly engineers, sales engineers, design engineers, really every type of engineer. I decided to kind of pursue that because of the analytical kind of framework that the way their minds kind of work is similar to how I kind of approach problems and systems. It's the way I kind of approached putting my business together is very systems oriented and making repeatable strategies to try to prevent to doing the same task twice kind of thing. And so because I kind of resonate with that a little bit more, say than, more marketing side or more, whatever else, I figured I could kind of talk to those people on their level and explain it in similar terms to what they respond to. Um, and yeah, that kind of is the impetus behind it. And so, I was talking to colleagues at past firms about different ways to invest passively, not just real estate, just basically just financial literacy as a whole. And engineers seem to respond kind of to this type of strategy because um, there's a lot of numbers behind it. It makes sense, from the scalability perspective and just from, specifically with my business, having a set process that they can easily follow. It's predictable. There's a specific kind of way we analyze deals, starting with like the market, the operators, the financials, and that sort of thing. And so I think breaking it down into kind of easily digestible steps helps a lot, specifically with that type of avatar.
Yeah, it makes total sense. When you perform diligence, on an operator or on a deal, what are the non-negotiables for Tony when it comes to, that diligence that you do, again, either on the operations team itself or on the actual deal, that you're looking to potentially deploy capital into?
Yeah, so I mean, on a deal level, the first thing we look at is the operator. What their track record is. Performance is really, I think, the best indicator. I know there's a lot of operators out there just getting started, so they don't really have that to show, which isn't necessarily a deal breaker, but it definitely means that the rest of the market, the financials, everything needs to be a lot more locked down. But yeah, so I would say operations and the operators the first thing. The second thing would be some of their projections. You don't want wild assumptions kind of running throughout the financial models. So I like to dig into that pretty deep and make sure that cap rates are being are justifiable. Rent growth, organic rent growth isn't out of the realm of um, realistic ranges. You don't want to see 10% organic growth every year. That it has happened, but it's not the typical, and you wouldn't want to have your returns um, based on that alone. So really kind of locking some of that stuff down, making sure expenses aren't unnecessarily or unrealistically low. There's different things like property management, insurance, all those things matter, and there's a whole bunch of different inputs there. So, um, really having a good knowledge of where those kind of ranges should be helps in the first place. And then again, my kind of knowledge, I can break that down for my avatar, which they respect and love looking at the numbers. So they then are more comfortable moving forward with a deal like that.
Yeah, it makes total sense. And obviously there's a lot of input that goes into, underwriting deals. And you brought up a lot of, what those inputs are. And oftentimes, the operator or the investor, is making decisions based upon what they think the future holds. But the challenge is we don't always know for certain, right? We don't know what the next black swan event's going to be. We don't really know, where insurance costs and property tax costs and cap rates or organic rent growth, we don't really know where those things are going to be in the next 3 to 5 years because nobody has that crystal ball. So a lot of, people that underwrite deals and evaluate deals, they're really making some assumptions on the future, right? And there are certainly credible, places that we can go to, buy that forward-looking analytical data, like through CoStar and RealPage and other, firms like that. But at the end of the day, those are also predicated largely on, big wild guesses as well, right? So, from an investor's perspective, it really comes down to mitigating against, operational risk, execution of the business plan risk, and then obviously, the uncontrollable, which is largely, that market risk. So, I know most of the investors that you talk to, Tony, they're smart, analytical people. What would be, maybe some of the biggest mistakes, that those individuals are making, and maybe perhaps that's just something as simple as they get analysis paralysis, then they never get started in the first place.
Yeah, I mean, I think that's definitely a big one. It's easy to get lost in the numbers, especially when there's so many different levers you can pull, like you mentioned. So, I mean, I've suffered from that myself for a while, getting started with things. I was always trying to make sure everything was ready to go and that I understood every single variable and piece of the puzzle. And you really don't ever get to that point. It's too broad a scope to really know everything, and so you have to get comfortable moving forward with some uncertainty. And that's, uncertainty is risk. But I think with specifically the underwriting and some of those assumptions, you aim for conservation there, as far as, what is reasonable based on past data, what is forward looking based on what's happening in that market. Is there, are there new units coming to the market? Is it, are things cooling off in that general area? So I think those are all pieces that help to mitigate some of that risk. And that's all important, from especially from that analytical perspective. I think another area that, people might get into trouble is taking things at face value. So, they read a marketing package, everything looks great because the numbers look great, but they don't really look the step deeper to see where those numbers are coming from. Because, 25, 30% IRR sounds great until you realize that it's based on the assumption that, like I said, the growth is astronomical, that their, expenses are probably a lot less in the underwriting model than what's going to actually happen when they get out there. The renovation plan, maybe is scheduled for a very short timeline, when that you don't really think that that's realistic. And so that's kind of where I've positioned myself to kind of help eliminate or mitigate as much as possible those risks.
I'm Zach Haptonstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in the large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investors. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
That makes total sense, and I appreciate you breaking that down. It's really kind of this, mental checklist that, people ought to go through, as opposed to getting too emotionally attached, to the investment, and certainly chasing after the highest IRR or the glossiest pitch deck is not really an investment strategy at all. I'd like to maybe drill down a little bit more into kind of the operator themselves, right? What are maybe some kind of non-negotiables as far as, operations go, right? Are you more tend to lean towards investing with operators that are, vertically integrated, that have been around for 10 plus years, that have a strong track record, that haven't lost investor capital? What's kind of your non-negotiables there? I always like to tell people I try to, do and perform diligence on the operator's heart, which is not an easy thing to do unless you've actually invested with them, in the past, and have an actual seat at the table, right? Most investors are, standing outside the house looking into the window, right? But you don't really get to know the heart of the operator unless you've, had experience investing with them in the past, and have maybe taken deals full cycle, and maybe have seen, how the operator reacts and responds, to the headwinds that sometimes are prevalent, in the marketplace.
Yeah, I mean, I think all the things you mentioned are important aspects and important things that you want to look at. Like, vertically integrated is always great. There's a lot more control that way when management's in house, construction's in house. A lot tighter control over timelines, budgets, that sort of thing. Especially, if it's a larger company that they've, implemented this strategy multiple times is a big piece because, someone that's implementing a strategy for the first time, there's a lot more unknowns naturally versus someone that's done it, 20, 30, 40 times that they, have a little bit better ideas of what those materials are going to cost on the renovation side, what they can get for certain insurance, stuff like that, is especially when you have, master policies and stuff like that in play. It's very different to go and get a one-off policy for a property over here. There's a lot more fluctuation there and variability in what the rates could be versus, a company that's, got 20 properties with a policy, a master policy. So I think that's also important. I've done deals with vertically integrated companies and not, and it works out okay sometimes when you're not as well, but there's definitely more headwinds, especially when the property manager say isn't working out, and you need to act quickly in that case. So it's not necessarily a deal breaker, but definitely again mitigates more of that risk, which my investors typically like to see as well. It's just, again, more of that cushion for them and that comfortability level. So, as far as non negotiables go, really, I mean, it kind of is a combination of that list you provided. So, you want to see some track record, you want to see that they are able to execute. Um, no investor capital lost is obviously a huge one. Some great operators have had some troubles over the last few years with the interest rate hikes a couple years back. Um, but I think communication is a really big thing when there are headwinds. Are they being honest and open and forthright with their investors? Are they telling them quickly so that they can respond? Um, you know, that sort of thing, rather than, kind of just ghosting and then you don't hear anything and you're not sure what's going on with your money that's tied up. So communication's a big one. But again, to your point, you don't really know fully until you've invested with someone kind of what they're actually going to do, because people can say a lot of things. So a lot of times I think also it comes down to the relationship. And so investors, passive investors don't oftentimes have relationships with a whole bunch of different firms that are doing these kinds of deals. So I think that's where it's helpful to find, fund managers and other people that, do have those relationships and can kind of vouch for that relationship piece. So I think that that's an important piece.
Yeah, it makes total sense. And this is real estate's very much a relationship, based business. And you're exactly right. And a lot of deals get done. A lot of investors invest, because they know, like, and trust, right? Well, I know, like, and trust a lot of people in my life, but there's not a lot of them that I would trust with 100 grand of my own personal cash, right? So that trust factor is incredibly important, and that's largely based on genuineness, authenticity, transparency, all those things kind of go into that. And it just takes time, for that to kind of build and mature, in a relationship. So I appreciate you, highlighting, that component. There's a lot of noise in the market. There's always a lot of noise in the market, whether it's, geopolitical, noise, or it's interest rate volatility, it's supply demand imbalance, it's concessions, it's where are we in the market cycle, relative to where we were, back in the peak of the market cycle in 2021. I know that you don't have a crystal ball, and neither do I, but, where do you think things are going to be, real estate wise, specifically in the commercial multifamily space in, say, the next 3 to 5 years?
So you hit it on the nose. I mean, it's definitely hard to pin that down exactly. No one really knows for sure. I think based on what we've seen over the last few years and kind of what markets are showing as far as supply, absorption rates, stuff like that. Rents seem to have stabilized a bit in most markets. They're not kind of flying off the charts like they were for a while. New supply seems to have slowed down in certain areas to kind of match what has been going on. And so I think that we're at a good point in the market where it's becoming more of a buyer's market where you can there's a lot of opportunity out there. A lot of assets are being repositioned over the last few years and over the next few years, where I think, there's going to be a lot of opportunity to pick up some quality assets for, sale prices, for lack of a better way to phrase it. So I think there's a lot of opportunity there. It's especially nice when you can, pick up a quality asset and not have to do a huge lift on it. Um, Cosmetically, or from a renovation standpoint, you can pick something up and put a new debt product on it and it works. Again, that reduces that risk there because there's not a lot of renovations always risk. When you have to open walls and change stuff, there's timeline cost, all that stuff. So long story short, I think it's very opportunistic time to buy at the moment, and I think it will be for the next few years likely. I think we're in a good point in the market where there's some money to be made there.
Yeah, totally agree with you on that. I would say within the last 36 months, most of the investments that I've personally deployed my own cash into, we're picking up those deals at between a 20 to 40% discount, in basis from what those types of products in that same submarket, were trading for, back at the peak of the last market cycle, just 36 to 48 months ago. So, whether you're investing in Wall Street or you're investing in Main Street through real estate, really it's the same adage. You want to buy low, sell high, right? Well, we're certainly in that kind of stage of the market cycle, where it's a buyer's market. It's not a seller's market. The only types of deals right now that are trading, or at least that I'm seeing being traded, are those that have, some element or layer of distress, where it's a forced sale, scenario. And that's why, I'm very bullish in terms of where we are in the market cycle and why I continue to double and triple down investing my own personal, cash into deals. So speaking of Wall Street and Main Street, I know you regularly talk about, how retirement accounts could actually be leveraged and used to invest into real estate. And I know there's a lot of people out there that probably have maybe a higher, degree of their nest egg, wrapped up into, Wall Street related investments. So are there ways that you have found that would work for that individual to diversify out of Wall Street and into Main Street real estate, investments without investing cash, into those deals?
Yeah, so retirement account investing is something we've been leaning into a lot harder lately, especially with engineers, because I feel like that's a group that typically doesn't get that kind of background information. A lot of people that are working W-2s, they invest in their 401ks and their IRAs, which through you pick where they're investing through. It's typically stocks, bonds, mutual funds, that sort of thing. So it mainly sits both with Wall Street, and lately we've been trying to educate people on the fact that you can reposition some of those funds to invest in Main Street and to invest in private assets, real estate, you name it. You really can have a lot more control over where you're investing those funds. You use self-directed accounts, which there's a lot of different places out there that help with that whole process. So you don't really have to worry about, knowing what you don't know and that sort of thing. It's definitely beneficial, I think, as well, because some of these deals, most of these deals are illiquid for a couple of years. Your money's tied up for 2 to 5 years, which, finding 50, 100,000 in cash to be tied up for that long. Um, the everyday person doesn't necessarily have that readily to just place and have as a discretionary investment. But within retirement accounts, a lot of people have that stuff, and it's actually super beneficial to not have all of that money tied up in stocks and bonds, because as we've seen recently, that it fluctuates so much. Stocks are speculative, and I can get into a whole thing on that as well. But it's another way to diversify those funds that are already illiquid. So yeah, I'm very bullish on that as well.
Yeah, it makes total sense, and you're exactly right. I mean, the reason why somebody would choose to do that is really to seek diversification, right? Because if your entire, nest egg is wrapped up into Wall Street, you maybe ought to consider, alternative, investments to reduce some of that exposure, to any one particular investment or asset class. So I'd like to, as we kind of look to wrap up here, I'd like you to speak specifically to that high net worth W-2 earner that feels stuck right now. They're not sure what to do. What would maybe be that first step that they could take, on their journey to looking into the potential of investing passively into a real estate investment?
Yeah, I'd say start educating, reaching out to some people to, kind of learn a little bit more about the process. It sounds a little bit daunting at the surface. There's, all these different moving pieces and parts. But when you have someone to kind of walk everything through step by step, it becomes a lot easier because it is very much, there's a couple different steps that it makes it a lot more simple. If you have someone that you can talk to and you can trust as far as looking at the way a market cycle is currently oriented and assessing a specific market, looking at financials, and is willing to sit down with you and break down what's important, what's not, and why it's important. um, you know a lot of those things are actually much more easy to understand than it appears. So I'd say start there. People in my position are more than happy to help you understand that thing. My main business is educating people. I have a network of people that I send out, weekly emails where I just kind of explain different parts of the process. We go over what returns mean, where we're at in the market cycle, that sort of thing, just to kind of spread awareness so that people know, because it's not really a thing that's front of mind for most people. And, you don't really get that education in school unless you go to school for finance. So I think that's the first thing. And the second thing really is just to not be afraid to take action when the time comes. It's easy to get stuck in those numbers, like I mentioned, but you know, you just have to get a little bit more comfortable moving forward and understanding and being comfortable with the fact that you don't know everything, and that's okay.
Yeah, no, that makes total sense to me. And it's good for investors to be able to lean on, individuals like yourself and myself that have been in the business, for the amount of time that we have. I tell investors, my wife and I are in 75 different real estate, syndications at this point, have invested with, dozens of operators and dozens of different asset classes, which, gave us a lot of knowledge, in the space. And, we've had deals that have been grand slams, and we've been in deals that haven't turned out so well, right? But it's a learning process. So your point about, number one, get educated, that's the most important thing you can do, right? Is to learn about the benefits of passive real estate investing. And then the second thing is, eventually you got to take action, because the best time to invest in real estate was 10 years ago, and as they say, the next best time is now. So really appreciate you unpacking that for us. Tony, this has been a tremendous conversation. Really appreciate the great value that you've brought our listeners today. What might be one or two different ways that we can connect with you to learn more about what you're up to?
Yeah, the best way is probably through LinkedIn. My profile is just LinkedIn at Tony Figliola. It's Figliola. And the second way would be through our website. It's www.passiveinvestmentpros.com. And yeah, we are constantly monitoring both of those, and are more than happy to talk to anyone who's interested to learn more.
Yeah, that sounds great. And we'll definitely put those links in the show notes for the episode. Tony, again, appreciate you being on the show today.
Yeah, thanks for having me, Jeremy.
And listening audience, thank you again for jumping into yet another episode of the On the Rise podcast. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the On the Rise podcast. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decisions, please consult with a professional. This show is copyrighted by the On the Rise podcast. Written permissions must be granted before syndication or rebroadcasting.